An estate freeze is often suggested as a way to transition your business. Today, let's go over how it works. Generally, an estate freeze is the preferred strategy to use when transitioning your business to your children due to its tax efficiency and ability for you as a business owner to maintain control. Here's how it works. Let's say you own a business that's worth $5 million. That $5 million of value will be reflected in the value of your common shares. To do an estate freeze, all you do is exchange your common shares for new preferred shares that are worth the same amount, $5 million, on a tax-free basis. Afterward, your children then subscribe for new common shares, and there you have it. You've just completed an estate freeze. You own preferred shares that are worth $5 million, and your child owns common shares with a $0 value. So what are the benefits? For one, your children are able to become owners of the business without going $5 million into debt. You've frozen the value of your corporation, and the children have simply received new common shares that are worth $0. They don't need to borrow any money to become owners. They are motivated to grow the business because your preferred shares are frozen at a value of $5 million. Any future growth will increase the value of their common shares, thus incentivizing your children to grow the business. If the business were to be sold in the future, by having your children as owners, they'll be able to use their capital gains exemption to shelter tax. The preferred shares you receive upon freezing your corporation can be created in such a way that you maintain voting control of the business for as long as you own some preferred shares. In the event your successors aren't running the business properly, you're able to step back in and take back control. From a retirement perspective, your preferred shares could serve as a retirement income. By gradually redeeming your $5 million worth of shares from the corporation, that's enough for you to pay yourself $200,000 per year for the next 25 years. Now keep in mind, the corporation will be making these payments, so making sure the corporation continues to be profitable is crucial. As your preferred shares slowly get redeemed, your estate tax bill shrinks. Let's say you only pay yourself $100,000 a year over the next 25 years, and let's also assume your shares have an ACV of 0, which essentially means the full $5 million is taxable. By reducing your preferred shares from $5 million to $2.5 million, you've cut your estate taxes in two. And lastly, we can get creative here, and instead of having your children subscribe for new common shares, you could have your family trust as one of your new business owners. No strategy is a perfect strategy, so an estate freeze comes with its own set of issues for you to consider. First of all, will your children love the fact that you're maintaining control basically until you pass away? Secondly, will your children be motivated to run the business to its full potential if they never have to put any skin in the game? 3, if you need this business to provide you with a retirement income, how confident are you in your successor's ability to run the business profitably? Will there be enough cash flow to maintain your lifestyle in retirement, the business needs, and your children's needs? And lastly, we cannot forget about divorce and separation. If your children get divorced or separated, your business might be in the crosshairs. So to summarize, an estate freeze works great if you're looking for a tax-efficient way of getting the next generation involved. It has many tax advantages, but like any strategy, make sure you weigh the pros and cons with your team of professionals before moving forward. Till next time.